Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CHERVON Holdings Limited annual report. CHERVON Holdings Limited offers a diverse range of businesses and services across various segments. The company's Power Tools segment provides power tools and accessories for consumer, professional, and industrial users under brands such as Flex, Devon, Ego, SKIL, XTRON, and ODM. In addition to power tools, CHERVON Holdings Limited also operates in the outdoor power equipment segment, offering outdoor tools and their accessories for professional and mass-market users. The company's products cater to a wide range of customers, from professionals to consumers, making it a significant player in the industry. Beyond its core business segments, CHERVON Holdings Limited is involved in various other activities, including investment holding, trading and financial management, sale of parts and components, design and operation of do-it-yourself products, and production and sale of gardening tools. This diversified portfolio reflects the company's commitment to expanding its offerings and exploring new markets. Overall, CHERVON Holdings Limited provides a comprehensive range of businesses and services across power tools, outdoor power equipment, and related industries, making it a prominent player in the global market. CHERVON Holdings Limited market capitalization of $9 billion is materially smaller than most of its industry peers, of roughly $118 billion. CHERVON Holdings Limited trades at a lower price-to-earnings ratio of 11 times and a lower price-to-book ratio of 1.1 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.63%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various market and economic factors. Revenue growth is primarily driven by the success of flagship brand Ego, which has contributed significantly to overall sell-through growth. Additionally, promoting online business development, expanding e-commerce operations, launching new products with improved features, and strengthening brand awareness through social media and diversified marketing activities have all played a crucial role in driving revenue growth. On the other hand, revenue decline is largely attributed to external factors such as China-US tariff tensions, which led to customers adopting more prudent procurement strategies, resulting in an 8.2% revenue decrease. The downturn in China's real estate market and contraction in the power tools industry have also contributed to the decline. Furthermore, the increase in cost of sales due to China-US tariff tensions has put pressure on profit margins, while higher fixed costs absorbed per unit as a result of lower production volume have further exacerbated the issue. The power tools segment declined by 18.3% from 2024 to 2025, highlighting the significant impact of these external factors on revenue growth. The net income of the company experienced a significant decline of 13.3%. This decrease was primarily attributed to a reduction in revenue and gross profit margin. The gross profit margin, which is a crucial indicator of a company's pricing power and operational efficiency, saw a notable drop from 34.7% to 32.9%, representing a 180 basis point decline. The net income decline was further exacerbated by the decrease in operating profit margins. Specifically, the operating profit margin decreased from 6.4% in 2024 to 6% in 2025. This reduction in profit margins indicates that the company is struggling to maintain its pricing power and operational efficiency, leading to a decrease in net income. The company's financial performance indicates a positive trend in operating cash flow. The net cash generated from operating activities has consistently increased over the past 2 years, with a notable jump from $167,684 in 2024 to $229,355 in 2025. This significant growth suggests that the company is efficiently managing its operations and generating sufficient revenue to cover its expenses. Furthermore, the cash generated from operations also shows an upward trend, increasing by $7,798 from $115,421 in 2024 to $123,219 in 2025. These figures collectively indicate a strong operating performance, with the company successfully converting its sales into cash flow. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over the past year. Initially, the overall debt level decreased from $195.6 million in 2024 to $154.9 million in 2025, indicating a reduction of approximately $40.7 million. However, when focusing on bank loans specifically, the decrease is more pronounced, dropping from $192,619 in 2024 to $107,754 in 2025. A closer examination of interest expenses reveals that net interest expenses have also decreased significantly, falling from $3,566,000 in 2024 to $1,782,000 in 2025. This reduction in interest expenses is a positive development for the company, indicating improved financial management and potentially lower borrowing costs. Overall, these changes suggest that the company has made efforts to manage its debt levels and associated expenses effectively. Management is optimistic about the company's outlook, citing a diversified channel strategy as a key driver of progress. The company has made significant strides through strategic product collaborations, such as its partnership with John Deere, and is expanding its presence in Europe through acquisitions and flagship stores. The company is well positioned to capitalize on emerging trends, including lithium-ion electrification and intelligent technologies. Additionally, the company's focus on core trades and professional users is paying off, driven by award-winning products and branding initiatives. The expansion of its footprint through partnerships with leading retailers and a digital direct-to-consumer strategy are also contributing to its growth. Financially, the company has made a significant turnaround, recording a profit of $97.7 million in 2025 compared to a loss in 2024. Management aims to maintain this stability by mitigating financial risks through its funding and finance policy. While there are no plans for major investments or acquisitions outside of expanding its manufacturing plant in Vietnam, the company is committed to investing in its growth and expansion. The company has a history of paying dividends to its equity shareholders. In 2024 and 2025, the company paid out significant amounts in dividends, with $18,091 being paid in 2024 and $118,717 being paid in 2025. These payments demonstrate the company's commitment to returning value to its shareholders through dividend distributions. That concludes the financial summary for CHERVON Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.